So deciding between whether to do 10% or 30% comes down to kind of what your instincts are. And a lot of it's going to be subjective as we go through each line here, but you kind of want to go through which direction feels better to go. So generally what I do with this worksheet when I'm working with clients is we go through each line here and we come up with an average. So I'm going to score at either 10 or 30, and this down here I'll calculate our average to say this is about how much should be set aside each month for cash reserves. So recurring revenue, do you have high recurring revenue or low recurring revenue? And I'm just going to use my own business as an example because it's probably the easiest thing to do. So for example, I have clients that pay every month, and so the question is, do I feel like I have a lot of recurring revenue or low? And recurring revenue would be someone that has, clients that pay every month for, any number of months onward. A construction company, I would say, I would probably lean more towards low recurring revenue because it's not the same person every month. But if your revenues are high enough each month, you may favor more of the high recurring revenue side. So it's kind of the thing of which one feels like a better fit. Same with an apartment building. Let's say you have a rental property. If you have a lot of units, I would say you have high recurring revenue. If there aren't many units, I would probably lean more towards the low, especially with a 6-unit building where as soon as you have a vacancy, you definitely see an impact on your cash flow. So it's kind of something to think about is how much of a difference in your cash flow is there with when there's a change from month to month. So for me, I'm going to just go right in the middle. That's kind of where I am as of the date of this video, 2024. 30 days in accounts receivable. I don't have accounts receivable because I have things set up where people are automatically pay on the first of every month. Apartment building wouldn't have accounts receivable either because the expectation is people pay by the 5th, otherwise there's a late fee. And I would say most businesses are probably on the low accounts receivable unless they're in a business where it takes, say, at least 45 days to get paid, just because that's the nature of the business. If that's the case, I would go with 30. In my case, I'm just going to go with 10. And dollar amount is also another factor. If you have a lot of money coming in on receivables, you can go with 10 because you're going to have a lot of cash coming in. If there's not a lot coming in over the next, say, 30 days, I would go with 30. Again, I don't really have an accounts receivable, but for forecasting what might be additional cash coming in, I'm probably just going to go in the middle. Sales pipeline, you want to think about how well your sales team converts leads and what you have for lead flow. For my business, it's a little bit slower because I focus more on these higher end type accounting functions than I do the day-to-day bookkeeping. So I would probably say I'd probably put myself somewhere in the middle. And you also want to kind of think about how do you feel about your marketing efforts too. In accounting, I feel like marketing's a lot more challenging because it's very much based on a relationship, and that can take more time depending on your personality. The age of the partners is a factor. You want to give some thought to, now this is more, I should really say business owners, the age of the business owners. A younger business owner probably has more desire to grow the business, get it larger, whereas a retiring business owner is maybe kind of on their way out, so there isn't as much interest growing the business. They kind of want to wind things down. Deciding which age to go with, I would probably say if you're still planning to work in your business more than 10 years, you could probably go with the younger side. So I would probably, for me personally, I'm going to score this a 10. I'm at age 45 right now, so I don't really see this as a career I would ever exit. I think it's something I'd do forever because I enjoy it. I like working with business owners, kind of helping them turn their business around. And it's something that works really well to do well into your 60s, if you still have the interest and drive to do it. So, business growth. How fast is your business growing? Are you getting a lot of new sales? You see your business continuing to climb each month? And this is kind of definitely on your instincts. Low growth or high growth would probably happen depending on. Sometimes you are going to have low growth because you get your business to a certain size and you're like, you know what? I'm comfortable at this size. I don't want to get any bigger. So you might want to score it a 10. If you're seeing a lot of growth, want to continue to grow, you might want to go with a 15. The reason we score it this way with growth is because you're putting a lot of money into advertising and marketing. So for me personally, I'm probably going to just go somewhere in the middle. Big purchases. So do you have, like in real estate, capital improvements? This would be a good one where you want to score at 30. But with capital improvements in real estate, there's a whole nother process we want to go through to look at building a cash reserves. And in some cases, if you're doing like a syndication, you might be raising capital for those improvements. So that's a whole nother thing we can get into if you're in that situation. But if you're looking to buy equipment, vehicles, things like that, you might want to score yourself 30. For me, my big purchases is mostly just continuing education and advertising and marketing, learning those skills. I wouldn't really call them big purchases based on kind of how that stuff works out, but it's something to kind of think about if you feel it's a big dollar amount that's going to come up that you're going to have to pay for. So I'm going to score myself a 10 on that. How many business owners are involved? I think the more business owners that are involved, the more people you got to make sure stay happy. That kind of depletes, say, the profits. And so having a higher cash reserves is a benefit. Whereas if it's just you, and you don't need nearly as much in reserves. This is a big one. If you are someone like myself who has clients, you will probably have a few clients that are real big tickets, and you'll have a few clients that are, a smaller dollar amount. This is something to consider. Do you have a client or customer that makes up a big chunk of your revenue? If you do, you're going to want to lean towards this 30%. And if you don't, we have a lot of small clients. The 10% is going to be fine because if one of those small clients leaves, it doesn't impact your cash flow as much compared to a big client that's going to make a significant change. So as of the date today, I'm probably going to lean more towards 30, and just because that's just where things are at this moment. This last one, liquidity, is really what is the cash position of the business owner. So this is kind of where you have to kind of go with, how do you feel? Say you need to put money into your business. Can you comfortably do that without an issue? Or are you strapped yourself because maybe you're not paying yourself enough from your business, or you're just kind of at that point where you're just starting the business and you just don't have a lot to put into it, or whatever circumstances, or they are what they are. So in my case, I would go with, I'm going to kind of go in the middle for myself. So that kind of gives us our average. So for me personally, 15% of my revenue should go into reserves, and that percentage is just fine. I'm comfortable with that number. And other businesses might want to do up to 30, and some may only need to do 10. What's interesting about how this works out, this ends up being about 2 to 6 months of expenses. So this is a good way to kind of play around with how much do you need in reserves, and then take this number, multiply against your revenue, and see what that dollar amount is. If that dollar amount makes a lot of sense to you, I say go ahead and do it. If you feel it's too high, just make adjustments to it. Again, this is all subjective. At the end of the day, you just kind of want to go with your instincts. And like anything in accounting that have these concepts, they're just guidelines to use. And you just kind of use them to your best ability or how you feel best fits your business. If you have any questions, please leave a comment below.